Risk. Risk means any peril, hazard, danger, chance of loss which is insured against. So for the damage or danger against which the insured take the insurance for is called as risk. So what is the scope of risk? Risk includes negligence of insured and insured's servant. So if the risk is triggered by the negligence of insured or by the negligence of insured servant, then it falls within the scope of risk. The insurer will still be liable even if it is caused by negligence. Maliciously by insured servant, not insured but insured servant maliciously triggers the risk, then the insurer will be still be liable. Risk does not include. So what are the factors that risk does not include? Risk does not include ordinary wear and tear, willful misconduct of insured. So if the insured willfully triggers the risk, like for example, he has taken life insurance and he willfully commits suicide, then insurer is not liable. There should be no willful misconduct of insured. The next is inherent vice of subject matter. So what is inherent vice of subject matter? It means natural decay. Say for example an apple. If you take insurance for an apple, the apple, if you keep it as it is, it will naturally decay itself. So that natural decay does not fall within the scope of risk. The insurer is not liable if the thing which is insured against naturally destroys itself. Cause of risk is related to. So this also falls within the scope of risk. So time of loss. See, when you take insurance, the risk should be triggered only within the policy time. It should not trigger before or it should not trigger after the lapse of policy. It should trigger within the policy time. Only then the risk it falls within the scope of risk. The next is causa proxima. In the first part of Unit 2, we saw briefly about causa proxima. Here we will study in detail. So what is causa proxima? Causa proxima means immediate cause. So it is the proximate cause. So what is proximate cause? There can be many factors that will affect the insured's subject matter, but only those causes which the insured has taken insurance against are called proximate causes. So it is the cause against which the insured has taken insurance for. So the section 55 of the Marine Insurance Act 1963 says that insurer is liable only for proximate cause. So the insurer is liable only if the risk is triggered by the proximate cause, or else the insurer is not liable. In particular, the insurer is not liable for willful misconduct, liable for negligence and proximate cause. So the insurer is not liable for any willful misconduct by the insured. If the insured himself willfully destroys the subject matter, then insurer is not liable. But the insurer is liable even if the risk is triggered by negligence of insured. The next is for ships and goods not liable if delay. So if the insurance is taken for ship and the ship delays for its departure time or arrival time, then the insurer is not liable. The risk is not triggered at that time. The next is not liable for ordinary wear and tear, breakage, leakage, and inherent. The insurer is not liable for proximately caused by rats. So if the subject matter is destroyed by rats, by biting of rats or damaged by rats, then he is not liable. By vermins, etc. There is a case law in this, Hamilton, Fraser and Co. versus Pandorf and Co. In this case, what happened was there was a ship, it was carrying a cargo, and the seawater entered through the pipes. The pipes were attacked by rats. The rats bit through the pipes, and when the ship sailed into the sea, the water entered into it, and the ship was destroyed. So here the question comes whether the accident happened due to rats or whether the accident happened due to water entering. So the insurance is done against the seawater, right? It is not done against rats. It was held that the damage was due to sea and not due to rats. Why this was done? The rats bit the pipes, but the court decided that the damage was due to sea water entering. To understand that, we will see the next succession of causes. If we see this, we will understand the proximate cause betterly. In the succession of causes, there is a case Pink versus Fleming. In this case, it was held that only the last cause has to be seen. So only the last cause which damaged the subject matter has to be seen and decided for insurance. So in the Hamilton case, the last cause was seawater entering the ship which destroyed the ship. So that's why only seawater is considered as a risk, as proximate cause. So in this Pink versus Fleming case, it was held that only last cause has to be seen. In the next case, Renault versus Accident Insurance Co. See, for example, if what happens if the last cause is not the proximate cause, if last cause is not the cause for which the insurance was taken against, then the immediate preceding cause is seen. If the last cause has been caused by the immediate preceding cause without any chain break, then it will be called as a proximate cause. It will fall in the scope of risk. Example, in the case Insit versus Railway Passenger Assurance Co. So what happened in this case was a person was weakened due to railway accident. So he suffered an injury in railway accident, and with that injury he was walking in the street, and due to his injury he was not able to avoid an accident by bus, and he was run over by a bus. It was held that the death was due to street accident and not by railway accident. The next, ratings of risk or elements of risk. So what the scope of risk ends there. The next, it is a different question on risk, ratings of risk or elements of risk. So ratings of risk are there on life insurance, marine insurance, and fire insurance. So what is the rating of risk? The rating of risk is the caliber of risk or the severity of risk, and it is affected by many factors. We will see one by one. For life insurance, how the risk is affected. The risk is affected by the age of the person. So if the person is old, then he will have a high chance of dying. If the person is younger, he will have a high chance of living. So risk is affected by age. It is affected by minimum and maximum limit age. It is affected by build. Build means height, weight, etc. It is affected by physical condition of the person, his sight, his heart rate, etc. It is affected by personal history, like his previous occupation, his previous habits, etc. It is affected by family history. Then it is affected by his present occupation. If he is working in an hazardous environment, then he will have a high chance of dying. Then the risk is affected by residence of the person. So if he is living in a good climate, then he will have a longer life. Then his present habits, whether he is drinking, smoking, etc., desiring life insurance. His morals, whether he is bankrupt, dishonest, etc. It is a major factor whether the insurer will take the risk or not. Then his race and nationality, his gender, his economic status, whether he is working in a defense service. So if he is working in a defense service, then there is a high risk for his life. And plan of insurance. All these factors affect the risk, the rating of risk in life insurance. The next is fire insurance. How risk is affected in a fire insurance? The risk is affected by nature of property, whether it is movable, immovable, etc. The character and constitution of the property, the area in which the property is situated, the situation and the locality of the property, exposure to outside danger, use and habits of assured, and the title to property. These are all the ratings of risk in fire insurance. In marine insurance, the rating of risk is affected by voyage and its nature, route of voyage, the route taken by the ship in a sailing, winds and storm in a locality, danger of war, capture and seizure. Then if the ship is prone to pirate attacks or mutiny of crew, etc. These are the rating of risk in different insurance. The next is premium. So what is a premium? The definition of premium is Premium is a consideration of contract of insurance, or it is a periodical payment on policy, property, or life of insurance. So premium acts as a consideration for the contract of insurance. For the consideration is premium, and the promise is the claim by insurance. The premium is also defined as a periodical payment on policy, property, or life of insurance. It is paid periodically to the insurer. Steps for calculating or charging premium. So what are the steps in calculating premium or charging premium? So it is the premium is decided on many factors mentioned below, like what constitutes claim, if it is caused by death, survival, or both. Then a claim period, it is paid at the beginning, it is paid in the end, or it is paid during year when the claim is paid, when the insurer is bound to pay the claim. It decides the premium amount. The number of insured, how many insured are taking policy. It will, if more number of insured takes policy, then the premium cost will reduce. If less number takes, then the premium cost is increased. Then duration of policy, for how much time the policy is going to be there. If the policy is there for short term, then the premium amount will be high. If the policy is there for longer time, then the premium amount will be lower. Probable number of claims per year, then value of claims per year, number of years of interest and present value of rupee, present value of claim each year, present value of all future claims. Then there is also a formula, net single premium is equals to present value of future claim divided by number of assured buying policy. So it basically means that if the insured are more, if the people taking policy are more, then the premium cost will be less. Forfeiture of premium or lapse of policy, when the insurer can forfeit the policy, when he can get rid of the policy. It means that if a premium not paid, insurer forfeits policy and keeps premium paid till then. So if the insured does not pay his premium, then the insurer has right to forfeit the policy, and whatever the premium the insured has paid until then, the insurer can keep all the money, all the premium to himself. He is not bound to give it back to the insured. Since it is a serious matter, a lot of remedies are given to the insured if he does not pay premium. So what are the remedies? The first remedy is days of grace. Days of grace is an important concept. It is sometimes acts as a short note separately. So what is days of grace? Say, for example, if the person does not pay premium on the specified date, the what insurer makes is he keeps extra days, like for example 15 days for a month to for the insured to pay. The extra 15 days will the insurer give to the insured to pay every month from the date is called as days of grace. There is a case law, Stewart versus Freeman. In this case, it was held that if premium is not paid, and in this case the premium was not paid by a person and the person died after that, and the days of grace were running, and one of his relative paid the remaining premium. It was held that the insurance was not valid and the premium was paid, and the insurer was liable to pay the amount, the claim, to the insured. The next remedy is non-forfeiture clause. So what happens in this clause is, if the policy is terminated, then the insurer should give the value up to the premium. Even if the premium is not paid, the insurer will terminate the policy, and whatever the premium is paid up to then, he will give claim of that. The next is non-forfeiture regulations. Then in non-forfeiture regulations, for 5 full years, if the premium is paid for 5 full years, then the insured will have claim against insurer. The next remedy is surrender value. In surrender value, if the premium is not paid even after the days of grace, then the insurer can return only 1/3 of the amount and keep the rest premium. The next is the renewal. Next remedy is renewal. If the insured does not pay premium, then the insurer can again renew the policy by taking penalty from the insured. The next concept is return of premium or refund of premium. When the insurer is liable to refund the premium to the insured. So where there has been fraud on part of insurer, if the insurer, the one who is giving the policy himself commits a fraud, then he is bound to return full premium to the insured. So if the fraud is committed on part of insured, the person who is taking the policy, if he commits fraud, then insurer has several rights. He may stop further premium and repudiate contract, or the insurer may go to apply to court and cancel the policy. And if the policy is matured, if the claim is already paid, then insurer can set up the defense of fraud of insured and recover the claim back or amount back. Where policy has become void ab initio. So if the policy was void ab initio, so it was void at the very beginning, then the insurer is bound to return the premium. So when the parties were never ad idem means there was a confusion between them. Ad idem means they were thinking same at the same time. So if parties were never ad idem, that is there was a confusion among the particulars of the insurance, then the insurer is bound to give back the premium. If it was ultra vires the powers of company, if the company was not authorized to give the insurance and the company still gives that insurance, then also the insurer is bound to return the premium. Terms of contract uncertain. If the terms of contract of insurance were uncertain, the according to Section 25 Indian Contract Act, it is not a valid contract and the insurer is bound to pay the premium back. Object or consideration was illegal and no risk incurred by the insurer. If insurer is not taking any risk and he is only taking premium, then he is bound to return the premium back to the insured. And in Section 84 of the Marine Insurance Act 1963 states that return in failure of consideration. If the consideration is failed, then the insurer is bound to pay it back and overpay premium paid. If the insured pays extra premium, then the insurer is liable to pay the excess amount back to the insured. So this concludes second unit. Thanks for watching.